Hello, this is a video for IME 315, Financial Decision Making for Engineers at Cal Poly San Luis Obispo. My name is Liz Schlemer. This particular video is on depreciation, although it goes together with a couple other of the videos, the tax video and the cash flow video, before it all will make sense. But we'll venture through this depreciation video first. So when we're talking about the 5 topics in the class, this particular topic falls under investment analysis, and it's also a little bit about reporting and managing profits. So the things I'm going to cover today are definition. I'm going to go over 2 methods of depreciation: straight line depreciation and accelerated depreciation. So when we look at the definition of depreciation, we are going to look at these sort of 4 terms: book value, depreciable basis, and salvage value. So depreciation is the recognition that assets purchased in one period will be used over multiple periods to produce revenue. So it's not just something like if you buy some paper this month, you'll use that paper this month. This is actually something you buy that will last for a long time. Depreciation also helps you to recognize that the assets decrease in value over time. That's kind of like their usefulness is used up, and that use is depreciation. And this relates to the book value, which means that when you buy the asset, it's worth some amount, but over time it decreases in value, and that value is called the book value. So the depreciable basis is another thing you need to consider, which is that every cost that's necessary to put the asset into service needs to be included in the initial asset value, or the depreciable basis, the amount that you need to depreciate. So this would incur purchase price of the asset, machinery or whatever it is you're buying, delivery charges, installation, any kind of calibration, any kind of training, anything that needs to be put expensed associated with putting the asset into service. Salvage value is another topic that's important in depreciation, and it's the estimate of the value of an asset at the end of its useful life, or at the end of the analysis period that you're doing an analysis for. And this can be, this is related to what can it be sold for in year N. One of the things you might want to look at is what is the scrap value of the asset. If it's at the end of its useful life, is it just metal and it can be scrapped, or is there a secondary market for this asset? So we're going to look at straight line depreciation first. So straight line depreciation is what you're actually doing is you're depreciating the same amount each year for the whole life of the asset. And this is an expense that will show up on the income statement. I will show you how that works. But what you first need to do is figure out what the depreciation schedule is. And in straight line depreciation, the depreciation in every year, D sub J, is equal to the investment amount minus the salvage value. So what you bought it for, the depreciable basis, less what you will be able to sell it for at the end of its life, and then just divide that by the number of years. So you can see what that will be is D sub J will be the same in every year of the useful life. Now for book value, which this particular equation works for any type of depreciation, book value in time period J is equal to the initial value minus all previous depreciation. So in this case, we're looking at, and if you look for the depreciation in time period 2, you'll take the initial cost minus depreciation in time period 1 and depreciation in time period 2, and that will be the book value. So this is the particular equation for book value that you'll need to at times calculate. So let's look at an example. What is the depreciation in each of the 3 years of the life of a widget tester that costs $12,000 with a $1,000 delivery charges and has a salvage value of $4,000? Use straight line methods. So in this case, we're going to use that equation to the left, and so every year D sub J will be 13,000, which is 12,000 plus 1,000, minus the salvage value, which is 4,000, divided by the life, which is N, which is life N, which is 3 years. So it's going to be $3,000 per year. So if we then look at what's the book value in time period 1, we take the initial cost of 13,000 minus 1 year of depreciation is now the book value is $10,000. The second year we take off another depreciation amount, and it means the book value is $7,000. The depreciation in time period 3, we're going to take 3 depreciation years of $3,000 per year, and that means that the book value at the end of year 3 is $4,000, which is also equal to the salvage value. So this is how we calculate both depreciation and book value at any point in time. And so you can see the depreciation is laid out in each of the 3 years. So if you just look at the first year, we have gross margin of $4,000, operating expense of $500, and then we have depreciation that comes out of that. So it would be $4,000 minus $500 minus $3,000 means taxable income is now $500. And if we use a 28% tax rate, net income is $360. So we're familiar with doing that calculation up to net income. But now in order to get cash flow, we add back depreciation, because depreciation is a non-cash item. It's a write-off associated with a previous expense. You remember we just laid out the expenses in years 1 through 3, but the expense actually occurred in time period 0. So we add that back in each of the years, and this becomes the cash flow then for year 1 through 3. So as one thing to remember is that as depreciation increases, it makes a higher tax shield, which will decrease taxes, which will increase cash flow. So one of the things we want is we want depreciation to be as high as possible when we're doing it, at least at the beginning of the time period. So an example here would be that if I have these 2 identical income statements, except for depreciation in one is $1,000 and then the other is $4,000, you can see that even though it's a non-cash item, because it is taken out of income before we calculate taxes, but added back in order to get cash flow. So it's sort of negated by the minus 1,000 in the first column, minus 1,000 and plus 1,000. But it does provide tax shields. So you can see the taxes in the first column were $1,120, but in the second column it's only $280 because we had higher tax shields. So cash flow is higher. So this is what you need to have is remember is that depreciation is higher, cash flow is higher. So let's look at an example where we have depreciation here at $10,000 a year. It's a straight line depreciation calculation, and I want to see that $50,000 that's depreciated. I want to see if I can increase the cash flow in the first years and decrease them in the ending years, because we have to have the same amount of depreciation. But you can see that actually that will increase the net present value because we're getting cash flow sooner. So this is the depreciation in each of these cases, $10,000 a year. And that gives us $22,960, which if we put it into a cash flow diagram, this gives us a net present value of $37,036. So we're calculating the net present value of all of those cash flows. So we're going to remember that, because what I'm going to do now is show you that if we can use an accelerated method, which means we get depreciation quicker, that actually we can get higher income, higher net present value. So I'm just going to put together a depreciation schedule. There's a lot of ways of doing this calculation for depreciation schedule, but I've kind of arbitrarily used depreciation time period. 1 is 20,000, 2 is 15, 3 is 10, 4 is 5, and I'm just going to have no depreciation 5. So this is an accelerated method. We'll talk about an accelerated method in the next video called MACRs, but this is an accelerated method. The total is still 50,000, but let's look at what that does to the cash flows and then the net present value. So in this case, you can see I have my depreciation schedule here that actually created tax shelters earlier in the system. And if we look at that, we can see the cash flow changes now over time because the depreciation changed over time. It's not a straight amount. So when I do my net present value calculation, it's going to be a little bit different. And I end up doing an equation now instead of using one of the functions in Excel. But I get the net present value is $38,044. And if you remember, the depreciation for the straight line method was $37,000. So I increased the net present value of this investment by $1,000 by just having a accelerated depreciation method. So this little example is meant to prove to you that it's better to have accelerated methods if you can. So there's various accelerated methods. Sum of years digits, double declining balance switching to straight line, and MACRs. The only one that we're going to cover in this class is MACRs because it's really the only one that's used. Even straight line is not used very often except for reporting purposes. MACRs is an IRS defined depreciation method, and it's what you will be using if you're doing analysis for a company. So this particular video covered investment analysis and a little bit on reporting and managing profits, and I hope you now have a little bit more of an understanding of depreciation. Look at the next couple videos because I think they're important to have a full picture.